Hey everyone, so today's video is going to be about diversification. Now we all know that we should have eggs in different baskets, but there's a few things I've been noticing, and a question I often get is, how do I get diversified? How do I get those eggs in different baskets? So that's what we're going to talk about today. So many of you may be familiar with this chart, but it's what's called a style box. So every stock out there could be put somewhere on this grid. And we've got large companies, medium-sized companies, and small companies. And then we can break that out further and we can talk about growth stocks versus value stocks. So a growth stock is going to return value to you as a shareholder. Their main goal is to grow their stock price as much as they can. They don't pay a dividend. This is going to be something along the lines of Amazon or Facebook, compared to a value company like DTE or ExxonMobil or Ford. They want to grow their stock price, but they're also going to pay you in the interim via quarterly dividends. Now, which one's better than the other? And the answer is, it depends from year to year. And then there's some companies that would be a blend, or a little bit of both. They're primarily focused on growing their stock price, but maybe they also pay a small dividend, maybe like an Apple. So, every time I draw this grid, it always makes me think of one of those old farmhouse doors where you've got the different window panes. And what I've noticed is, a lot of folks have gravitated more to the names that they're familiar with, the services they use every day: Netflix, Snapchat, Facebook, Amazon, Google. And they've been rewarded for that. They've been outperformers compared to the broad market for the last few years. But what I've noticed is, if the majority of your portfolio is allocated in this part of the market, and a rock goes through this window, but that's your entire window pane, it's going to be pretty traumatic and pretty time intensive. You might have to buy an entirely new door rather than just being able to say, well, I'm still okay, even though this part of the market was blown up and a rock went through this part of the window. It's going to be a lot less traumatic just to swap out that one window pane in for something else. So the name of the game really is, we want to have eggs in all these different baskets, a well-diversified portfolio. Now from there, you hear a lot of people talk, on the news about the S&P 500. So that would be this part of the market. There's some medium-sized companies in there, but for the most part, it's the biggest 500 companies in the U.S. So from there, we really have to decide, how am I going to get my eggs into those different baskets? We really have three choices. So the first choice that you have would be to look at individual stocks or bonds. So you could literally go out there and buy all 500 companies inside of the S&P 500. The second choice you have would be to look at mutual funds. So with a mutual fund, you are hiring a stock picker and his team of analysts to beat whatever their benchmark is. If it's a large cap fund, they're trying to pick the best, maybe 50 stocks out of the S&P 500 every single year. Now for that, they're going to charge a fee. On average, between 0.5% and 2.5%. And I'll be the first one to say, I'd pay somebody 10% a year if it meant that I was going to be able to beat the market every single year, right? And that brings me to the third choice that we have, which would be ETFs, which stands for Exchange Traded Fund, or index funds. So the primary difference between ETFs and index funds and mutual funds is that we're not paying somebody to choose what to buy and sell inside of there. Instead of hiring someone to pick the best 50 stocks out of the S&P 500, we could just buy the entire S&P 500. Jack Bogle, founder of Vanguard, has a famous quote that says, don't try to find the needle in the haystack, just buy the entire haystack, and there's always going to be a couple needles inside of there. So at the end of the day, what really matters to us is not only cost, but the value I'm receiving for what I'm paying for. Am I getting what I'm paying for? Well, ETFs, because we're cutting out this middleman, are much more cost effective. They're about 1/10 as expensive, which makes sense. It's a prepackaged, service or vehicle to get you exposure in all those different areas. It could be as broad as the S&P 500 or as specific as large value companies, for example. So there's a study that comes out every single year, and what the study really evaluates is, are you getting what you're paying for by hiring a professional stock picker? And really the results of the study show that over any sustainable amount of time or any sustainable time period, about 90% of the professional stock pickers out there do not justify their fee. They don't beat the benchmark that they're trying to outperform. So to say it another way, you want to know how to beat 90% of the pros out there? Just by the benchmark that they're trying to beat. And I really like these odds. So with that, hope everybody has a great rest of your day, and please reach out if you have any questions.